Chapter 1 of Auditing talks about the demand for audit and other assurance services. So basically, the nature of auditing is accumulating and evaluating evidence in order to make a decision. So normally it's going to be accounting data that we're looking at, or that's again the one that we'll focus on the most often. So there needs to be some level of criterion that you're comparing the data to. So from an accounting standpoint, that's going to be generally accepted accounting principles or GAAP. The auditors then will go through what they call evidence, which is going to be the electronic data, the transactions that the company has actually processed all through the period that's under audit. It could be communications with people who work in that business or with their attorneys or other outside people. It could also be observations of the auditor. So the auditor may go and look through journal entries or look through the accounts payable vouchers or payroll records or things like that. An independent person. So the auditor is normally that independent person, and for most of our big accounting firms, they have to be a CPA or in the process of becoming a CPA, and that they don't report or have any direct links to the company that they're auditing, which would make them independent. Then they're going to actually communicate their findings in some sort of a report or letter to the management to verify that, hey, everything looks like it's in accordance with generally accepted accounting principles, or maybe they discover some sort of issues or misstatements. So who kind of demands these audits or these audited financial statements? It's primarily banks and investors. So banks are loaning companies large amounts of money, and they want to make sure that when they're looking over their financial statements that they're legitimate. Investors are investing, maybe they're in their retirement funds or their stock market funds into those companies, and they too want to make sure that their financial statements are accurate and that they're able to make good decisions. So that's really, and then you can't necessarily trust the company without having that independent double check. So again, we talk about two different types of risk. So there's business risk and then there's information risk. So business risk is the chance that the company is not going to be able to pay their loans or their, or even remain profitable from an investor standpoint due to changes in the economy or different types of risks within their operation. Are they able to stay competitive? Are there any lawsuits or bad publicity that's happening for them? Those are all kind of business risks. Information risks are the chances that the financial statements that the bank or the investor is looking at are actually incorrect or have some significant errors in them. So auditing can reduce that information risk. Obviously, auditing can't change the business risk, but they can make sure that help to ensure that the financial statements are prepared in accordance with GAAP. Again, there's no guarantees in auditing, but it just reduces that risk. And one thing that makes it hard, as it mentions here in the PowerPoint, is in today's environment with large, multinational corporations, there can be just volumes and volumes of data that the auditors have to be able to kind of skim over and make sure that they are looking at all of the material transactions. And then too, there can be foreign exchange differences. It could be companies that are, again, multinational and have conversions from euros to dollars and a lot of different complex accounting transactions. So to reduce that information risk, again, that information risk will help to reduce the interest rates. So that's why the businesses want to do that. They want to be considered a less risky enterprise so that their bank loans will be at a lower rate of interest. But so some ways to do that would be like user verifications, which would be like due diligence that was prepared by the business, or if there's been IRS audits. The user is also going to share that information risk with the management of the company itself. And then the most common way, though, is to get the audited financial statements to verify that these larger companies have prepared these financial statements and they've been audited by independent external auditors. So that's the most common way for businesses to do that. Assurance services are independent professional services that improve the quality of the information that's presented to the bankers and to the investors. So there's attestation services, which basically are reporting on the reliability of those statements. So that's where the audit comes into play. The audit is an attestation service. We can also have audits of the effectiveness of the internal control structure, which we will talk about that in future chapters as well. And then there can be a review of historical financial statements. Those are not quite as high level as an audit. And then there can be other attestation services, which we will also talk about. But normally your big companies, your big publicly traded companies that are selling stock in the stock market are audited, and they're audited by the external auditors. Reviews are done for more privately held companies or smaller companies. They still may want that done, or their bankers may still want that done if they have loans, but your bigger companies will be an audit. So some non-assurance services, we have accounting and bookkeeping services, tax preparation services, management consulting. So these are all things that your CPA offices will still provide, but they're not related to the audit and they're non-assurance services. So the types of audit, we have operational audits, compliance audits, and financial statement audits. So operational audits are looking at their procedures and verifying that their procedures as they're outlined are efficient and effective. And that's not just limited to their accounting department or their accounting procedures. It could get into purchasing and receiving and inventory management. So kind of out there in the operations of the business as well. A compliance audit is determining if they're following a set of rules, such as like government regulations or tax laws. So those would be considered more of a compliance audit. And then the financial statement audit, again, is kind of the bigger picture, that we're looking at the financial statements and we're deciding if they are prepared in accordance with generally accepted accounting principles. So the types of auditors that are out there are, the first one that we think of always is CPA firms. So those are our external independent auditors. And then there's all levels of CPA firms. So obviously we have our top 4 firms that are international firms and are very well known, and our big companies are using those. Then we'll have more regional ones, and then we'll have local CPA firms. So there's kind of all levels. Obviously, the higher you go, the more expensive, and the bigger companies are going to be taking those high-level CPA firms. Then there's also the government accountability officers, where we're auditing on behalf of Congress, so more of that, governmental accounting focus. IRS agents who audit tax returns prepared by businesses or individuals to make sure that people are following their tax laws and there was nothing, misfiled or incorrectly filed. And then individual companies can hire their own internal auditors, and a lot of times banks will have internal auditors. But then those people are actually reporting to the company's management. So they're going to just be looking at all the details within the company to make sure that policies and procedures are being followed as they're outlined, possibly maybe even documenting these procedures, and working more with those internal control processes. So to become a CPA, a person has to meet the education requirement. Then they have to sit and pass the state CPA exam. And then they have to work for so many years as a CPA. or as an accountant in order to become a CPA. So they could have passed the exam but still have 2 years of experience that they have to complete before they actually can use the title CPA or sign a document, a CPA. So that is kind of just the basics of what is in Chapter 1. So kind of just understanding auditing and then the role of the accountant in the auditing process.